Good evening. My name is Mark Barnico, and I'm the Executive Director of the University of Chicago Francis and Rose Yuen campus in Hong Kong, our premier location in Asia, representing UChicago values of free and open discourse, rigorous debate, and the exchange of ideas. Welcome to the new China on the Move series. We're sharing tonight's event live via Zoom, Facebook, and YouTube from the University of Chicago Yuen campus in Hong Kong. If audience members have questions to submit, you can do so through the questions and answer button by first registering on Zoom. I also encourage you to visit our website at www.uchicago.hk for the latest news and information. Or you can also follow us on our UChicago Yuen campus social media accounts on Facebook, Instagram, and Twitter. We'll wrap up tonight's program with a poll and more information about upcoming events you may be interested in. So be sure to stay tuned until the very end. The newly developed series China on the Move was created to provide objective academic insights into current events shaping China and its future as a global player. UChicago scholars and their guests will share deep expertise and interpret contemporary events from historical, sociological, political, economic, and other perspectives to attempt to provide a balanced view of China. Tonight, we kick off our China on the Move series with our first episode, Evergrande and Beyond, Debt, Development, and Chinese Society. Our panel will discuss the history and social dynamics that have shaped China's real estate market, the nature of the current bubble, implications for both private and public finance, and possible fallout from the Evergrande crisis with China and beyond. But first, let me start with a brief introduction of our moderator tonight. Kenneth Pomerantz, our UChicago Yuen campus Hong Kong faculty director, will moderate tonight's panel. Professor Pomerantz is a distinguished university professor of modern Chinese history and in the college. University professors at UChicago are selected for their internationally recognized eminence in their fields, as well as for their potential for high impact across the university. Only 23 members of the University of Chicago faculty have received this honor. Today, only 10 faculty members hold the university professor title, which is an incredible distinction. Professor Pomerantz's work focuses mostly on China, and he's also very interested in comparative and world history. Most of his research is in social, economic, and environmental history. But he's also worked on state formation, imperialism, religion, gender, and many other topics. Some of Professor Pomerantz's award-winning publications include The Great Divergence, China, Europe, and the Making of the Modern World Economy, The Making of a Hinterland, State, Society, and Economy in Inland North China, 1853 to 1937, and The World That Trade Created. Professor Pomerantz is one of the world's leading scholars of modern China. His current projects include a history of the Chinese political economy from the 17th century to the present, and a book called Why is China So Big?, which tries to explain from various perspectives how and why contemporary China's huge landmass and population have wound up forming a single political unit. Thank you for joining us again, Professor Pomerantz. I'll hand the stage over to you so that you can introduce your panel and start the conversation.
Thanks very much, Mark, and welcome everybody. Tonight's panel, Evergrande and Beyond, is the first of a two-panel series on China's real estate situation and its broader implications. And I'm really excited. We have three outstanding speakers tonight. I'm going to introduce them all at the start and in the order in which they will speak. So first we have Professor Meg Rithmire, who is F. Warren McFarlane Associate Professor in the Business, Government, and International Economy Unit at Harvard Business School. Professor Rithmire holds a PhD in government from Harvard, and her primary expertise is in the comparative political economy of development with a focus on China and Asia. Her first book, Land Bargains and Chinese Capitalism, examines the role of land politics, urban governments, and local property rights regimes in the Chinese economic reforms. A new book in progress examines state-business relations in authoritarian Asia, comparing China under the CCP, Malaysia under the Barisan Nasional, and Suharto's Indonesia. Some other related work concerns the role of the Chinese Communist Party in China's political economy and trade and investment conflicts between China and the United States. Her work has been published in World Politics, the China Quarterly, Politics and Society, and other scholarly journals, and her commentary has appeared in The Atlantic and The Washington Post. Next, we have Dinny McMahon, who is the Global Fellow of the Woodrow Wilson Center for International Scholars. He is the author of China's Great Wall of Debt, Shadow Banks, Ghost Cities, Massive Loans, and the End of the Chinese Miracle, a ground-up look at the mechanics of China's political economy, which he wrote while a fellow at the Woodrow Wilson Center. He later moved to Macro Polo, the Paulson Institute's think tank in Chicago. Paulson Institute also has a relationship with the University of Chicago, and there he researched China's efforts to clean up its financial system. Dinny started his career as a financial journalist in China, spending 6 years in Beijing with the Wall Street Journal, 4 years with Dow Jones Newswires in Shanghai, where he also contributed to the Far East Economic Review. He is currently working on a project for the Wilson Center on China's efforts to reduce its reliance on the US dollar. And he also provides independent research on China's financial system for financial services firms. Last, but by no means least, Professor Zhiwu Chen is the chair of finance, Victor and William Fung Professor in Economics at the University of Hong Kong. He is also director of the Asia Global Institute and former professor of finance at Yale University from 1999 to 2017. His research covers finance theory, the sociology of finance, economic history, quantitative history, emerging markets, as well as China's economy and capital markets. He was a special term visiting professor at Peking University and at Tsinghua University. Professor Chen started his career by publishing research papers in top economics and finance journals on topics related to financial markets and theories of asset pricing. Around 2001, he began to expand research beyond mature markets by investigating market development and institution building issues in the context of China's transition process and other emerging markets. He led successful efforts to construct historical, financial, and social databases from China's historical archives, and has also written extensively on economic and social history topics. He started the annual Summer School for Quantitative History and International Symposium on Quantitative History at Tsinghua, and continues to organize them at Beida, with the goal of promoting quantitative historical research in China and beyond. So we have 3 very exciting panelists. They'll each speak for about 10 minutes to get us started, and then we will move into discussion and Q&A. So Meg, can you get us going?
Sure. So first, let me just thank the University of Chicago Center in Hong Kong for getting us together. It's a real privilege to appear alongside the 2 other speakers from whom I've learned so much over the last 20 years. So listen, I'm not an expert on how global capital markets will be affected by what's going on in China, or even how Chinese capital markets will be affected. But I am a specialist on China's political economy. And so what I thought I would do was start off with the question of sort of how did we get to a place where a firm in China has been this large, this indebted, and is this likely to generate what some people have called a Lehman moment or a lost decade moment for China. Both of those are open questions that refers to, of course, the moment that started the global financial crisis in the United States, a crisis that we actually exported around the world, and the burst of a housing bubble in Japan, which led to maybe 2 now lost decades in Japan. And so I'll say a little bit more about whether those are the correct reference, and I'm sure my panelists have opinions as well. But it's interesting that this firm has emerged so indebted and so systemically risky in the context of China, where we think of the CCP, the Chinese Communist Party, as managing a very strong state with a very strong role of the state in the economy and a very tightly controlled financial system. And yet we have this kind of outcome. So to answer that question, let me just talk about two things. First is the institutional foundations of what we're seeing in China right now, and then a bit about the political issues involved. So the thing to know about how China works when we think about real estate firms and debt in China, at least from the perspective of my research, is the institutional foundations, the way that the Chinese state governs two major inputs to production, and those are land and capital. And so let me talk about land first and then capital second. So in China, real estate contributes about 20% of China's GDP, and it's much higher in some parts of China subnationally, even double that as the ratio of real estate to GDP. And for most of the post-financial crisis period, so post-2008, China's investment to GDP ratio was in the upper 40s, in some places even 49, 50%. And that's pretty much the highest rate for any country for which we have data historically, unless Professor Chen corrects me there. And even before the kind of financial crisis after 2008 to 2010, 12, when the investment in real estate was at a real peak in China, we saw urban development proceeding at really what's a world historical pace. So the building of cities, the making of new urbanites at a rate that's kind of unseen in all of world history. And in fact, some of you may remember, and I know Dinny knows a lot about this, the 2012 scare about ghost cities, and this kind of scare that urban construction is proceeding in a kind of state-driven, anti-market way, overinvestment likely leading to a bubble, this kind of recurrence of this concern with frequency over the last 10 or even 15 years. So how does this happen? So how is land governed in China? And some of you know a lot about this, but all land in China is owned by the state. And so in urban areas, the state is represented by municipal governments, and in rural areas, it's represented by rural collectives, which kind of holdover institution from the Maoist period. And it's very hard for the collective to speak for itself. So in essence, it's owned by rural governments in its own way. And how it works is that urban land, so being owned by the state, is not sold properly to other users, but leased for long-term periods. And those lease sums are paid in upfront sums that basically provide some sort of windfall income for local governments. And so over time, really since the mid-1990s especially, for a reason that I'll talk about in a moment, local governments have come to depend on this revenue from land lease sales to meet their expenditure burdens, which are quite heavy. And so in 1994, there was a major fiscal change in the Chinese political economy that left local governments still responsible for the lion's share of local expenditure. So things on infrastructure, health, social security, education, all public goods and services, basically. But they no longer had access to locally generated tax revenue. But they did have the ownership of land. And so they began to lease out land as a way to earn revenue, whether they want to use that revenue to enrich themselves or provide things for the people within their jurisdictions. And so we have this massive march where land used to comprise 0% of Chinese local government income to more than 50%. They're getting more from land leasing, much more than they are really even from tax revenue or other forms of revenue that they take in. And so the interesting part about this as well is that local governments in rural areas that own the rural land or rural collectives are unable to negotiate really effectively to sell their land at proper prices. And so this gap, this delta between the ability of urban governments to extract rural land at low prices and sell it or really lease it to real estate developers at high prices has really been the engine driving local government expenditure over the last 15, maybe even 20 years. So let me say something also about the capital system. So if that's how land works, so we see how the incentives are then for local governments to basically invite more and more real estate development, to lease more and more land and invite more investment in their areas. And they get money from that. And they also get a boost in GDP from that, which they want to show for political reasons within China's kind of system of promotions. So then we come to the financial system. So how does it work then that you have a real estate firm that's able to borrow so much money from Chinese banks such that it owes $300 billion and can't meet its debt obligations? So here what we see is actually a liberalization of the financial sector that happened really over the last 15 years. So really significantly since 2003 and 2005. And so it used to be, especially in the 1980s and 1990s, the private sector had no access essentially to the Chinese financial system. So Chinese banks, they lent to state-owned enterprises, and state-owned enterprises use those funds maybe for inefficient purposes, but in any case, the private sector was closed off to borrowing in China. And this led to all kinds of things, good and bad. Some of the good things was it led to a very self-reliant and kind of scrappy and clever private sector. But the bad thing, of course, is that we might think that if the private sector had access to credit, it might have been much more dynamic and driven much more efficient growth and allocated resources more efficiently. So what happens in the early 2000s is the financial sector is sort of softly open to the private sector. So there's an intent to lend more to the private sector, but there's not an accompanying liberalization in things like interest rates or development of kind of credit institutions. And so you still get banks that want to lend to people, to firms that are even non-state firms, but only trusted ones. And so all of this basically works on political relationships. Was not accompanied by regulations on risk and either market or political discipline. And so the idea is that, connected firms have a hard time failing because the government doesn't want to see them go down and doesn't want to tolerate the social consequences of widespread bankruptcies, nor is there the kind of political architecture for disciplining people within the financial system. And we're starting to see now under Xi Jinping a big crackdown on financial system regulators, both the securities sector as well as the banking sector, partly because the party found itself unable to discipline these people who were so close to so much money and power and yet so far away from the party's center of gravity and center of discipline. So what do you get in such a context? You get massive incentives for these banks to lend. And so in my experience, bankers often get a kind of introductory fee when they lend money to firms, and that they get themselves. And so the incentives are for firms to borrow more and more and bankers to lend them more and more because that makes their fees even higher. You have poor corporate governance, poor supervision of what firms are doing. So very little insight from shareholders, even especially minority shareholders, into what these firms are doing and how much they're borrowing. And you have in China a system of financial repression, which is a very high savings rate, so 50% of GDP at its height, which is very high for any country, and very low deposit rates, equity markets that are underdeveloped. And so you have households that have a lot of savings, but unable to put it anywhere. And so real estate seems to be a good place to put it. So all of this leads to a question that turns out to be a question of politics, which is a kind of interesting question. So why would a company make such crazy decisions? So we have Evergrande, this company that has made decisions that have led it to be this indebted and led it to invest in all kinds of sectors, including football teams, electric vehicles that are well outside of its core competence. So why even this company donate hundreds of millions of dollars last year in 2020 to vaccine development when it was already the most indebted company in China? And the answer is really something about state business relations and the politics of being a private sector firm in China. And so there's been some great reporting on this, and some of my co-panelists have been quoted in this reporting. But how you grow big in a sector like real estate, or really any sector, including technology, is you have relationships with everyone, local government officials, national government officials, to protect you. But even in the context of these relationships, you're fundamentally vulnerable to a policy change if the CCP decides that real estate's not going to work this way or such behavior is not tolerated. So you kind of do things to make yourself less vulnerable. And that includes hiding assets overseas, getting way too big to fail so that there's no possibility that the government can take you down. And all of this generates what we might think of as very short time horizons. And so especially under Xi, the idea that my political relationships are fundamentally in jeopardy anytime things could change. So the incentives start to become, how can I extract the maximum current value from my assets and not really worry about the future? How can I pay myself the most I can right now and not worry about who's holding the debt certificates in the future? And we see exactly that kind of behavior with Evergrande. And fundamentally, it's a form of what economists call looting. So taking as much current value as you can and worrying about the social externalities for someone later. So when we think about what the CCP is doing with Evergrande right now, it's really trying to crack down on this kind of behavior, the financial manipulation and the looting, as well as try to address these structural characteristics in terms of the ownership of land and the function of the domestic financial markets. And whether they'll be able to do that is fundamentally also a question of politics. And so with that, I will let my other panelists say, I'm sure, much smarter things about how the financial markets work and the politics of all of this, but thank you.
Okay, well, I'll jump in here. Thanks very much, Meg. That was fantastic. And Ken, thanks very much for inviting me along today. I'm going to say a few words about the potential for contagion from what's happening with Evergrande at the moment. Certainly, there's been a lot of talk about this being China's Lehman moment. But of course, everybody, the idea of a Lehman moment sort of means something different to kind of everybody. I mean, are we talking about a financial crisis that ricochets around the system, or are we talking about sort of like a collapse in economic growth? The problem with the concept of a Lehman moment when applied to Evergrande is that no one ever really talks about the mechanics, the mechanism by which distress at Evergrande, or a default by Evergrande, makes its way through into into something that destabilizes China's banking system. And ultimately, we're not likely to see that, regardless of the impact that Evergrande's problems and the broader problems of the property sector have on China's economy. It's not likely to destabilize the financial system, at least not in the medium term. And one of the reasons for that is that Chinese banks, when they lend to property developers, they are required to overcapitalize their loans. And so you have a situation where banks lend to a developer like Evergrande to build a residential complex. And for every $100 that or 100 yuan that they demand in collateral, they can only lend out 70 in credit. I mean, China's banks have traditionally had a reputation as effectively being glorified pawn shops. And that sort of thing is sort of being poo-pooed, globally, because it's really not how banks are supposed to work. But at the end of the day, when it comes to ensuring security against something going wrong, such as a moment in this, it's really quite a, it's quite a positive thing. So if you look at, if you look at that sort of situation where the banks hold a lot of collateral in their lending to Chinese property developers, you have a situation whereby, if they have to claim the collateral, even if property prices collapse, and even if they have to sell off that collateral at fire sale prices, ultimately the banks are reasonably safe because they're going to be able to get their money back. Now, of course, in the short term, there will be an increase in non-performing loans. It typically takes about 18 months for creditors to pursue their claims through the legal system and eventually be able to sell off their assets and get what they're owned. And so that's upwards of 18 months of banks holding non-performing loans on their books. But just because it's a short-term spike in bad debt that banks are holding, it's not destabilizing, because ultimately it is not going to be sort of a long-term burden on China's books. Now, of course, on the books of China's banks. Now, that's kind of a long-winded saying of, there is no real reason to expect that Evergrande's distress will sort of undermine the broader confidence in China's banking system. Now, of course, some banks might be more affected by this than others. I mean, certainly there's talk that Shengjing Bank in northeastern China has not only lent significantly to Evergrande, but actually holds a lot of its bonds and has a significant shadow banking exposure as well. But even there, if there's one bank or even a small number of banks that are starting to feel distress, it's not likely to have that same sort of ricochet effect that we saw with Lehman Brothers in the United States in 2008. And that's partly because of the way China's banking system has been set up to kind of minimize the sort of the degree of financial interconnectedness between China's banks. But in addition to that, China's regulators have actually built up an incredible amount of experience over the last few years in dealing with bank distress. So starting in 2019, we saw China's authorities take over Baoshang Bank, recapitalize, effectively nationalize Hongfeng Bank, deal with distress at Bank of Jinzhou, and a whole lot of, they've been dealing with distress and recapitalization of a lot of small banks under the radar over the last few years as well. So you would expect that if any bank sort of emerges from Evergrande's problems with a disproportionate amount of exposure and rising distress, that the authorities are in a pretty good position to be able to ring fence it and prevent it from becoming a broader problem, let alone a Lehman-esque sort of crisis. Now, that's not to say that there won't be contagion effects arising out of Evergrande. And in reality, we might already be seeing this. So the data coming out of China's property sector at the moment is incredibly weak. We're seeing housing prices decline, not just for newly constructed housing, but particularly for the existing housing stock. We've seen that for the last 6 months in a row, the volume of new projects being started has been declining. And the last time we saw that sort of slowdown was in 2015. The most recent round of land auctions by local governments have been abysmal. The sales by China's top 100 property developers in October were 32% lower than a year earlier. And we've also seen, in addition to Evergrande, we've seen Evergrande's distress, we've seen a spate of defaults. Now, of course, the problem with all of this is that this doesn't necessarily have anything to do with Evergrande, because the backdrop to Evergrande's problems is efforts by China's central authorities to effectively reduce the contribution, or make a better way of putting it, is an effort starting in the middle of last year to make China's property development sector safer, and by extension, reduce the contribution of that property kind of makes to the economy. So in the middle of last year, Beijing imposed on China's properties what's generally referred to as the 3 red lines policy, whereby it instituted 3 metrics measuring the level of Chinese property developers' debt. And according to whether the developers violate 1, 2, or 3 of those lines, then that determines how much more debt a developer can take on. So if a developer is in violation of all 3 of those red lines, they're not allowed to increase their debt levels. And if they are in violation of 2, then they can increase it marginally and whatnot. And so even, one of the reasons, or perhaps the key reason Evergrande is in this position to start with, is because of this state-imposed tightening of credit conditions, tightening of its ability to borrow in the first place. But it hasn't only affected Evergrande, it's affected the property sector more broadly speaking. And so the softness that we're seeing, slowdown we're seeing in the market, is in large part driven by these 3 red lines, but it's unequivocally being exacerbated by Evergrande's problems. And there is the potential for what's happening with Evergrande to further feed into that dynamic in the months ahead. So I just wanted to say a few words about exactly what, where the potential for that contagion or those knock-on effects from Evergrande actually are. And the first is with the US dollar bond market. And I think we're perhaps seeing this most clearly at the moment, because over the last month, we've seen 3 different Chinese property developers default on US dollar bonds. And a number of others are sort of scrambling to get their hands on dollars to avoid the same fate. So one of the effects of Evergrande's troubles has been to result in yields in offshore dollar bonds issued by private sector Chinese developers to spike, such that we're now at a position where that sort of debt is prohibitively expensive for developers to raise. And that creates real problems, because offshore dollar-denominated debt has become a very important source of financing for Chinese property developers. And traditionally, the way that they have redeemed maturing bonds is by issuing new bonds. Now, that's no longer feasible because the cost to issue a new bond has become so exorbitantly expensive. And so we're in a situation where developers kind of need to do a couple of things. They need, in order to redeem those bonds, they have to find a new source of credit. Ideally, it would be dollar denominated, but that's increasingly difficult in this environment. And then they need to be able to convert renminbi that they have in the mainland and then convert that to dollars and move it offshore. Now, the State Administration of Foreign Exchange last week effectively hinted that it was willing to expedite applications for this sort of transfer, but there are all sorts of reasons why that might not necessarily go smoothly. But this is exactly how Evergrande spreads contagion, because if the yields on offshore bonds remain stubbornly high for a long period of time, then you'll have a situation where more and more Chinese developers are forced to redeem their offshore debt, which means having to find some other source of find some source of other debt. Then they have to get their hands on dollars in a sufficient volume in sort of the time frame they need. And none of that is necessarily a given. They're both too big ifs. And the reality is that developers have traditionally borrowed US dollar bonds because it's been a relatively cheap source of funding. So whatever they now borrow to replace those bonds is going to be more expensive. So developers, because of Evergrande, developers are going to, a significant part of their funding is going to become more expensive at a time that the sector is already broadly under stress. Now, the second source of potential contagion is through the land market, which Meg has already sort of explained the importance of land sales to local governments. But the problem here is that when a developer runs into problems, the way that they raise cash to be able to deal with those issues is firstly by selling the existing land bank they have and by selling their projects. And so that means that local governments now have a new source of competition for selling their land. So, we're perhaps already seeing this dynamic play out. So if you take Vanke, one of China's biggest developers, the local press has broadly reported that Vanke hasn't been engaged in the most recent round of local government land auctions. However, they have been buying projects from Sichuan Langguang, which is a large Chinese developer which defaulted on a bond in July, and buying projects from China Fortune Land, which defaulted on a bond in February. Both of those developers are going through restructuring, and Vanke is engaged in buying up their assets. And so you have a situation where local governments are already financially overstretched, and all of a sudden, the pool of potential assets that healthy developers can buy has expanded massively. Not only can they buy land from local governments, but they can also buy projects and land, presumably at significant discounts from their peers that are in a period of distress. And the last sort of knock-on effect I sort of would like to mention before I throw over to Zhiwu is pre-sales. So pre-sales has been a major source of funding for Chinese property developers. So not only do they borrow from banks or from the bond market onshore and offshore, but what they do is they sell apartments prior to completion to Chinese households. And something like 90% of all housing sold in China is sold prior to completion. And this has been an incredibly important source of funding for developers, and increasingly so over recent years. Firstly, when there was a crackdown on shadow banking, which meant that this sort of marginal source of funding they were reliant on was no longer available. And even more so since the three red lines were introduced, because funds raised from pre-sales aren't considered a form of debt under the definition of the three red line metrics. So the real risk here is that a default by such a large developer such as Evergrande starts to change people's willingness to buy housing prior to completion. Because essentially they're not sure whether it will be delivered on time or delivered at all. Now, that's not to say that you're going to have a nationwide, universal turning against this concept of pre-sales. But what could potentially happen is that Chinese home buyers start looking for the next Evergrande. They start looking for the next developer whose finances aren't necessarily that strong, that might potentially default or might not be able to complete construction of a pre-sold housing unit, according to schedule. And so what you potentially will or may end up with is sort of the equivalent of bank runs, except on developers. But the difference is with a bank run, it's about people taking their deposits out of a bank. With pre-sales, it would be a case of home buyers no longer being willing to provide developers with the finances that they are so heavily dependent on to be able to finish their projects. And so that is kind of we're not necessarily seeing that at the moment, or if we are, it's not clear, because we are sort of seeing a softening of property demand around the country, at least sort of outside of the first two, the tier one cities. But certainly, even though we're not going to see, it's highly unlikely, or actually it's the mechanisms for problems in Evergrande to feed through into a financial system or a mainland banking system problem. The mechanism really isn't there for that to happen. There is certainly the potential for knock-on effects arising from Evergrande's problems to kind of further create difficulties in China's property market, in addition to that burden imposed by the three red lines already. Anyway, I'll leave my comments there and pass on to Zhiwu.
Yeah, thank you, Dinny, and thanks to Meg to both of you for doing such a wonderful introduction and covering all the major topics and questions. So because I'm the third person to speak, so I will just try to talk about something or things that have not been touched upon. Of course, of the last few months, especially the last 2 months, have become more popular in the sense that many media requests have arrived in my email box and so on. And I have to say, sometimes I have found it difficult to understand, why so many journalists, especially because I watch CNBC every day, guests on CNBC always like to use Lehman Brothers case as a point to draw analogy and so on. Every time when I hear anyone on CNBC saying that, I say, come on, this is not, Evergrande is not Lehman Brothers, because in the Chinese institutional context, a crisis like that, it's not gonna happen. So since I know for sure, in the coming months, the coming years, there will be many more episodes like Evergrande and Evergrande and so on. So maybe let me start my first point by really talking about the institutional background of China being really very different from the American or British or Canadian, Australian contexts, in the sense that for understanding the Chinese system, economic or otherwise, it's very important that the party controls everything. I'm not saying the party controls everything, every moment, every day, in every corner of the Chinese society. No, there are not so many Chinese Communist Party members, but whenever there is anything important, then there is no limit on what the regulators and party officials can do or cannot do. The reason that I say there will not be a Lehman Brothers type of financial panic or financial crisis, it has to do with the party's power or ability to basically tell everyone, bank, business, or individual investor, lender, borrower, to just stop doing anything anyone wants to do. I mean, for example, as it has been practiced in some regions or some counties or cities where the local party officials would tell the real estate developers and buyers and sellers from dropping their prices. So they can just ultimately also, if nobody would listen, then they just freeze the property transaction registration system. So you can say, you have signed this agreement with the seller for you to buy this housing unit, but you cannot register that transaction in the system because the local government would just stop taking any such request to register any transaction. So without transactions being allowed, when and if the prices are below what the local government allows, then there will not be new prices to be created that are below yesterday's or last year's prices. So when that is the case, then the bank mortgage loans and other real estate related loans will not be in any technical default. Because if you use the stale prices from a few months ago or from a few weeks ago or a few years ago, because since then there have not been any new prices, then the banks will not be able to foreclose on any mortgage loans. And then the bank's financial conditions will also look pretty good because, hey, there's no default because no real estate prices have been created that would make many of the mortgage loans go under due to be in a technical default. So when housing prices can be frozen and housing transactions at prices that the government does not allow can be prevented from happening, at least in the near term, then the financial system and everyone else would be at ease. So no panic is needed. Of course, if there would be a real bank run or panic by investors and depositors to go to the bank, well, and the government officials can also say, well, nobody can take any money out. I know this happened in the US in the early 1930s, but in China, anytime, any day, it could happen. I mean, there is no limit on what the government or regulators can do or cannot do. To make a long story short, in some ways, the party has this power, this control to reallocate and transfer wealth among different players and participants and stakeholders. So when that is the case, usually financial crisis would not have the soil to really occur. So I hope I've made it easy enough or clear enough that American officials cannot do that. That's why Lehman Brothers was allowed to just get out of control until the federal government, the Treasury, came in to organize rescue or whatever arrangements. But in China, then the officials, the regulators, have no such limitation. Anytime, every day, they have been doing that. Just like this case of Evergrande. I mean, many Western journalists were speculating, gee, is the government going to come in to help to rescue Evergrande? I said, well, to my knowledge, one of the top regulators was in Guangzhou for like 10 days to be on site to manage and arrange a way out for Evergrande, and that's what the central and local governments do. I mean, some time ago, one of my former students was the CEO of a large municipal bank, and then I asked him, about 7 or 8 years ago, how do you spend your day typically? What percentage of your day is on loan renegotiations? What percentage would be on, political studies, studying the new speeches, and what percentage on new businesses? He said at that time about 60% of his day would be spent in loan renegotiation meetings, typically with the local government official being in charge, getting some unrelated businesses and financial institutions, lenders, and then borrowers and real estate developers all in the same room to work out different arrangements for different players so that everyone would be made happy. Okay, so the institutional environment in China makes such Lehman Brothers like panic very, very highly unlikely to occur. So this is why back in the 90s, there were many books written on the upcoming banking crisis in China. Of course, all the major banks were indeed in major troubles. They were in technical default by 1999 or 2000, but then no real banking crisis happened. And then there were more books coming out to all call on some upcoming banking or financial crisis to happen in China. They all applied a free market, constraint or limited government framework to analyze China. But that's not how the Chinese institutional system is set up. The party has no limit on what it can do or cannot do. Of course, this brings me to my second point, that is, if China has been able to manage all the ups and turns so well over the last 30 years, then why don't we say they should continue doing that? Indeed, if you actually calculate the volatility for China's GDP growth rate, it has been very, very smooth. So we always say that hedge fund managers do such a good job on managing risk and managing their investments. I would say probably there are not many hedge fund managers who are as good at managing risk as the Chinese financial policy makers and financial regulators, because there has not been really any major financial crisis or economic crisis getting out of control. So if that's the case, then why do we say that China should do more market-oriented reforms and so on? Well, as Meg was summarizing so wonderfully, unfortunately, all the moral hazard consequences tend to add up. And then I don't see any way for how this game has been played will be played differently going into the future. So what I'm trying to say is that there will be more Evergrande, more unbound types of cases coming up. But then if you are thinking as an investor or speculator, wanting to know how you should be positioning your portfolio or do your trades, I would say, yeah, well, at least in the near term, just like I did about 2 months ago, when the US stock market was going down for quite a few days because of the Evergrande story exploding in the international media. I said to many of my friends, so this is a great opportunity to buy more American stocks, because it's not going to happen. It's not going to be a financial crisis. So I would say probably in the near future, as more such stories come out, then there will be repeated panic selling in the U.S. stock market and other stock markets, and then very soon they will all realize that China is not like the U.S. or Europe. So financial crisis does not happen that easily. But then, because this game will be played again and again, we should expect the repeated use of monetary policy to always come in when things cannot be continued anymore. So as long as inflation is not too out of control, then the central bank and other economic policy makers in China will always be there to not even hesitate for a moment to come in. So ultimately, the bubble will have to burst at some point, but the way it will burst, as I would like to emphasize for my third point, is to really use the Japanese experience as the benchmark. I think not only culturally speaking, but also in terms of the financial regulators and central bank's way of thinking, there's a lot of similarity. So this is why I think the China bubble eventually will end in a Japanese style lost decades framework. So I think for what I know, many of the financial officials or regulators, they do try to really manage a soft landing. Everyone knows there will be a landing at some point, but the way they're trying is to almost maximize the probability that a Japanese style soft landing will be achieved. So this may mean some years of slow growth or no growth, but then as long as no external forces will come in to stir things up, I think they may have a decent chance to manage some soft landing so that there will be a relatively long period of time of no growth or slow growth. But financial panic, financial crisis of the American style is highly unlikely to happen. All the investment excesses and wasteful spending, wasteful projects will be gradually digested over time with slow growth, but they will not end in a big splash Lehman Brothers style financial crisis. Let me stop here. Thank you.
General question of my own, which is, we've heard, to the extent that I could hear from everybody, about ways in which the current situation has been building up for a long time, and there's a need to sort of dismount from certain kinds of institutional blockages. And I'm old enough to remember a similar discussion in the early 90s. And then the problem seemed to be that all the financial resources were at the local level, the central government was being terribly squeezed. How could they ever dismount? And then the other discussion at the time was the terrible debt burden of the SOEs. Would the government ever be able to pivot, or were those vested interests too strong? So let me start by asking whether, and of course, in both cases, the Chinese government did successfully manage to pivot. They did manage to move against vested interests in the SOE sector, and they did reform their tax structure so that the central government got revenue back, albeit at the cost of creating other rigidities, some of which we've heard about tonight. So what are the prospects for a kind of major reconfiguration to get China out of this current impasse? And I'll just throw that out to any panelist who wants to ask it or answer it, and then we'll go from here.
I guess maybe I'll say something about that. It's a great question. And of course, the 90s did bring about a bunch of sea changes in China's political economy, including the SOEs and a total change in the financial system and the fiscal system in China, which, as you say, produced kind of other consequences, which now they're trying to solve now. So just on a couple of issues on the way they're trying to change some of these things. So one, and someone asked also in the Q&A box about a property tax. And then the other is how they're trying to introduce, I think, more discipline into the financial sector. And I just have to say, I tend to agree with everything that Professor Chen said in terms of moral hazard and risks accumulating over time. And one day it's going to have to bottom out. And how that happens, whether it's orderly or extremely disorderly, depends on a lot of things. And part of the reason I'm writing a book comparing China, Malaysia, and Indonesia is to try to figure out if China looks like Suharto's Indonesia, where you have a financial crisis and then some major political consequences, or does it look more like Malaysia, where you have financial crises that the regime survives? But you'll have to wait for those conclusions. But in terms of the property tax, there's a lot that's going on here now on the property tax, and this is not China's first rodeo with the property tax. So there have been many attempts to introduce a property tax over the last 15 years. The most successful of which really was in Chongqing under Bo Xilai, whose many policies have now been replicated at the national level. But in any case, part of the reason why it's so difficult, and Hong Kongers need no introduction to this, having watched capital fly into Hong Kong over the last 2 weeks, is because it's politically difficult to figure out who owns all the apartments and then tax those people, because it's really part of the party state elite taxing itself. And so we should think of Xi Jinping's anti-corruption effort and these efforts to change China's political economy institutions as going hand in hand. The other thing I just wanted to say about that is we have seen a huge change in the financial sector in terms of the party state itself asserting a role in corporate governance in Chinese firms of all kinds. And so it used to be that Chinese firm, we thought of state-owned firms and privately owned firms, and those were distinct. And at this point, when you get into corporate filings, and part of it is after the financial crisis of 2015 in China, But when you get into corporate filings, it's not difficult to find the party state, even as as an extremely minority shareholder. We're talking less than 5% in almost any firm in China at this point. I mean, maybe half of firms. I mean, it's a really pronounced role. And that gives the party state much more insight into corporate governance practices, a much closer relationship with managers and owners of firms than it's ever had before. And in the West, that's tend to be read as, the state's trying to control every firm and it's a security risk for everything. But my read on that is really that what happens is the CCP now sees business behavior as something that's fundamentally risky to its political imperative and wants a new means of controlling firms. And so that change in the financial sector from, a kind of banking regulation, securities regulation moment in China to the state as shareholder, the state as, corporate governor is a really difficult transformation and an important one to watch how that unfolds. So those are at least two things. I tend to be more pessimistic about the property tax than just because that's what history has taught me, but I'm sure my panelists have something to say.
Yeah, maybe I can jump in also to add a somewhat different perspective on this. For the last 4 decades, the most commonly used mindset or belief among the official decision makers is to use growth, to use the increment rather than the stock to solve whatever problems that may arise. So this is why Deng Xiaoping had this famous saying, development stupid. So as long as development is happening with growth to create more big delta in terms of more wealth, more income, then out of each 1 million who gets 100,000 more, who gets $100,000 less, is easier to handle. But when there is no growth, or when growth is becoming more difficult, then the trouble really becomes much harder to handle. This is why I think with all the other political institutional changes that have taken place over the last 10 years in China, so growth, or at least the incentive for private business growth, has been cut again and again. So now it's, if it is not negative, now it's at least very close to zero. So that has made growth going forward more difficult. So this is why during the current and the next phase of problem solving in China, almost there is no other way out except monetary, more money printing. That's going to be the most heavily relied instrument because growth is just not so much there anymore.
If you don't mind, Ken, I might just chime in with one last thing. You kind of gave the examples of what happened in the 90s and early 2000s in terms of big structural reform. In sort of the course of my career, the big shift that was kind of surprising and unanticipated was the reining in of the shadow banking system, which when that first, they tried rhetorically, they kept talking about it for years, and then they effectively turned on a dime and starting 2017, but really biting in 2018, they managed to massively rein in what was perhaps the single biggest structural threat to the stability of China's economy and financial system, such that today it's not really a threat at all. And I see what's happening with the property sector in some ways as being part of that trend. So the reforms of the property sector today, the efforts to rein it in, are both an effort to continue the de-risking of the financial system, and it is also an effort to try and change the role of the property sector in the economy. And I just want to sort of echo something that Professor Chen said a minute ago, like the idea of Deng Xiaoping back 20 years ago saying, it's all about development. Well, I think at this point, it's become pretty clear that the property sector no longer serves the interest of the state, regardless of how you define it, whether it's the party or the public or whatever. Housing is too expensive. Too many people are plowing their savings into housing in an environment where the population is shrinking and there just isn't going to be the demand there as there once was. And so if you listen to what the government wants these days. It wants more affordable housing. It wants to create a culture of rentals, whereby young people who are graduating from university or moving from the countryside can afford good quality, reasonably priced accommodation. And they want a situation where the developers aren't making outsized profits from a system which just doesn't serve the national interest anymore. And so I think these, we're at a point, and it's in some ways these problems have existed for a while, but I think we've kind of seen in the nature of very deep-rooted reforms over the last 5 years that there is a commitment to change that we hadn't seen in at least the decade before that.
Thanks, everybody. So I want to plant one question for you to have in the back of your heads, which is, we've seen China's growth cycle through a series of drivers, which in each case people have decided had gotten too big, right? So there was the export-led phase, and at some point that was simply no longer sustainable. There was the state-led infrastructure investment phase, which became a new source of demand as exports tailed off. And then there was real estate, which I think we've all heard good reasons to think got way too big. What comes next, if anything? And if nothing, then are we at a Japan-like bubble moment? So I want you to keep that in the back of your heads. But before that, I want to interpose a question from one of our listeners, which Amanda Lee from the South China Morning Post, who asks, if the property market is headed for a big correction, what happens to local government debt? The Chinese government has stepped up to try to control the so-called hidden debt risk, referring to the off-balance borrowing by local government financing vehicles. Do you think those measures are going to be effective to control the debt risk? And to now combine this with another person's question, if the government has to bail out, central government has to bail out local governments on a big scale, what happens to the larger political economy of center-local relations? So we've got a cluster of questions there. I would say let's start with those last two.
Yeah, can
please, you go first.
Yeah, Ken. Yeah, I would say the very likely route out of that is just to print more money, freeze housing prices, and print a lot of money very fast, so that the nominal housing prices will not go down. In fact, they may still go up a little bit. But the depreciation of renminbi will be much faster than the increase in nominal housing prices. So that will make all the banks very solvable in nominal terms, and everybody will be happy. So I think this is ultimately, I think, given the political institutional infrastructure in China, ultimately this is the way to go. Personally, of course, I don't like seeing that happening, but that's most likely the way out.
I'll chime in on this as well. On the issue of dealing with hidden debt, to the best of my knowledge, the authorities, although they've been talking about it a lot, have really struggled to come up with effective ways of dealing with it. When we're talking about hidden debt, we're effectively, for the most part, we're talking about debt raised by local government financing vehicles. So it's just a question of, well, what do we do with it? How do we pay it down? What is the mechanics? And I don't think there's really a clear strategy for dealing with that at the moment. Now, they've tried various things over the years. A few years ago, there was talk of, there were a couple of particularly indebted cities in Jiangsu, and there was talk about converting hidden debt to effectively officially recognized debt, or maybe not officially recognized debt, but kind of, replacing their debt burden with kind of long-term bonds or long-term bank loans. So effectively kicking the can down the road. Hopefully the whole thing will take care of itself, or, growth and inflation will mean that in 10 years' time, these debts don't really mean anything. I wrote about a ghost city up in northeast, up in the northeast, and its two local banks were incredibly indebted. From what I understand, China Development Bank effectively stepped in and the debts sort of disappeared into the ether. But that is not a solution for nationwide for the sort of size of the debts that we're looking at the moment. One thing that's kind of bandied around every now and then is that Chinese local governments actually have an incredible amount of assets, whether it be, well, land, but other than land, it's, forest resources and mining resources. And perhaps most importantly, it is equity in state-owned enterprises. So there's always this kind of residual question of whether we can kind of take mixed ownership reform and kind of turn that into a mechanism for selling off state assets, which will then be a way to service the debt. And we have kind of seen signs of that sort of happening at the margin in certain cities from time to time. But again, particularly in the most financially struggling locations in China, being able to sell off, the value of their state-owned enterprises aren't necessarily going to yield the value. You're not necessarily going to find the buyers necessary to be able to sort of pay down the debt. So it is still an open question at the moment. There are clearly tools at a micro level, in addition to what Zhiwu just said about, sort of a more macro monetary policy approach. But I think perhaps the best articulation of what the fallout's going to be is that it's going to be kind of a sharing of the burden between the central government mobilizing its own resources and the banks having to take it on the chin. The banks ultimately will be kind of forced to absorb the losses, and that will require greater bank capitalization and whatnot. Now, over what time period that gets sorted out, or when we really start seeing the stress, it's still hard to say, but that might be what we're left with, sort of a responsibility sharing setup between the central government and local governments, plus the banks effectively accepting responsibility for an increased volume of bad loans.
I'm not sure I have much to add to that. I agree with what both Dinny and Zhiwu said, except for that on just one last thing, which is, Professor Chen was talking about, and I was talking about the difference in how China governs land and capital, right? But it also has more control over people than most governments with which we're familiar through the institution of the hukou, which most people are familiar with, which means that they have some control over migration patterns in China. And so while there are ghost cities in China, they're not all ghost cities, right? And in some places, this kind of construction of supply-driven urbanization has ended up combining with changes in how migration regimes are governed to make it so that the state has control over both supply and demand in that way. And so we shouldn't lose sight that there is this tool also. So I think it's true. Many local governments are going to find themselves really hard up and going to need those kinds of bailouts or some sort of resolution. But others are going to find themselves now owners of what used to be Evergrande assets, and they're going to be able to sell them and do fine. And so there's variation there. And just to Ken's question, to keep that in the back of our minds, I painted a pretty pessimistic picture of state-business relations in China. And I think, the interesting thing about where are we going now? Well, the obvious push in China is toward high-tech development, right? And technology as the driver of economic growth. And it's worth pointing out that a lot of the dynamics in those sectors in terms of state government loans that are going easily to technology firms have been subject to the same kind of predation and fraud at the margins as we've seen in other things. So companies suddenly declaring themselves semiconductor fabs and then making off with a bunch of local government investment money. And so, it's like everything in China, it's not all that. Some of it's quite successful, but we shouldn't dispense with our knowledge of how the debt, the political dynamics, and the political imperatives have worked in property, because the same kinds of forces are going to be at play when it comes to technology. These questions about, is the government going to bail out technology firms? Is the government going to bail out, local governments that have invested in AI and, have had, fraudsters take their money out of the country? And so none of this is going to magically go away as the growth model shifts to another kind of engine.
I can't help being reminded of a headline in the satirical paper, The Onion, back when the US bubble burst in 2008, which said, American public demands new bubble to invest in, right? But I want to bring in another question, which I think dovetails rather nicely with Professor Chen's suggestion that one of the big policy tools we're going to see at work is lots and lots of money printing. And the question is, does this mean that China is headed for something like a post-92 Japan scenario, in which you print lots and lots of money, you still don't get much growth, and you get long-term close to stagnation? How likely does that seem to people?
Yeah, Ken, I would say that should be the base scenario. I think of course, I'm biased for economic and investment decision makers. I would say that stagnation scenario is the most likely way out, provided that the external geopolitical and also internal political unexpected events would not happen. Then the central banker and Ministry of Finance and local governments and so on, they will have a lot of time to gradually digest and use a lot of printed money to smooth the lending process. But unfortunately, at this point, in fact, it's not just Evergrande. There are many other things that are also going out of control in their own ways. So all the different forces may actually complicate this success probability to achieve a Japanese style soft landing. So in that sense, I would give the economic decision makers in Beijing 99 points out of 100 if they would be able to succeed in achieving a soft landing over the next 10 to 20 years. This is such a hard question.
If not,
yeah, I think only the finance professor can handle it. I would defer for sure.
Okay, then maybe we should pivot to a somewhat different kind of question, in some ways equally hard. But we've talked a lot about the banks, we've talked about the development companies, we've talked about the government. You also have an awful lot of private citizens who have prepaid for Evergrande apartments that are currently unfinished. And we know for some of them, that's their major asset. And some of them seem to be pretty angry. Any thoughts about what is likely to happen with them and to what extent they're likely to be bailed out?
I'll go first on this. Look, the authority's priority with dealing with Evergrande, and they made it pretty clear from the beginning, is it's about getting the projects finished. So it's whatever cash that Evergrande can get its hands on when they're not paying off US dollar bonds, it's about keeping the wheels on the projects and make sure as many as are finished as possible. Now, of course, part of the process of now restructuring Evergrande, assuming that that's what we're going to see in the near future, is that it's going to have to sell off as many of its assets as possible to raise cash. Now, in terms of the interests of home buyers, that's not a bad thing, because if Evergrande can sell its projects to Country Gardens, to Vanke, to Jinmao, then that means that a more reputable, financially sound developer has now taken over, and that those projects are more likely to get finished on time. I think you're also going to see at a local level, particularly in some of these smaller cities, particularly those that have a particularly soft property market, that you're not going to get large, China's large, nationally operating developers step in. And in that sort of situation, you might see political pressure from local governments will mobilize their local state-owned or even local private developers, somehow provide them with the resources to be able to step in and finish those developments as well. Now, of course, that's not going to be able to happen everywhere. I mean, I'm assuming that some local governments are going to be too financially overstretched to be able to, to do that. In some cases, it won't be a problem because pre-sales haven't started yet. But in those cases where, you know, the project effectively gets stalled indefinitely, then, you know, the priority will be able to sort of damp down dissent in, you know, in other ways, whatever form that might take. So I you know, particularly over the next year, when we've got a sort of a political transition year coming up, and that's going to be you know, a whole lot of people moving into new positions. I mean, no one's going to really want to see sort of, you know, political unrest, regardless of how small it is. And so I think the priority will be, you know, getting projects finished, paying off families, and, you know, stopping them petitioning, just by hook or by crook, ensuring that there is a minimum of, you know, vote, you know, sort of a minimal expression of anger and frustration over what's happened with Evergrande. So I think that's likely what's going to probably shake out.
Yeah, I agree with Dinny. In some sense, I'm much less worried about those buyers of Evergrande property, because Evergrande has become such a political case. So all local governments are taking this matter much more seriously than normal, so that those buyers of housing from Evergrande will be made sure that they will be delivered something physical. But I'm much more worried about buyers of much smaller, lesser known real estate developers' promises, because they are more likely they want to be sacrificed, because local governments will pay much less attention to those other cases are not related to Evergrande.
It's an interesting and grim thought. So we have a couple of questions that I think can be collapsed into a common question, and maybe a way to frame it is to start with a comment Dinny made, which is that part of any solution is that some of the lenders are going to have to take it on the chin. And of course, lenders include both domestic and foreign. There are obvious reasons for the Chinese government to favor paying off the domestic lenders, which leads to a question about how much of this is going to ripple beyond borders and how.
I might go first with this one. You know, in terms of favoring domestic borrowers over foreign borrowers, I don't think it's quite that simple. So if you take Evergrande, for example, you know, Evergrande will go through a restructuring process, but ultimately something that looks a little bit like Evergrande will come out the other side. There'll be debt for equity swaps. There will be extensions of loans. Somebody will step in and recapitalize the rump of whatever's left with Evergrande. And Evergrande will come out the other side and will continue to be a property developer in China. It will also continue to be a Hong Kong listed company, presumably. It probably will also want to raise money again from the US dollar bond markets. Now, for that to happen, it probably needs to be able to give US dollar bond holders a deal comparable to onshore dollar bond holders. And even just going beyond sort of Evergrande specific case, if Chinese companies want to continue raising, private sector Chinese companies want to continue raising money offshore, then bondholders, international bondholders have to have a fair sense that they are going to be treated fairly, and fairly is something along the lines of what onshore bondholders sort of get. Now, of course, there is nothing written in stone to say that will happen. The way this entire system is set up is that bondholders foreign bondholders are technically out on their own with this because they don't have recourse to the onshore assets. However, I think the politics of all this means that they're not going to get any more raw of a deal in a meaningful way than what the onshore debtors have to put up with. I think when we're talking about ripples among global markets, we're kind of talking about a more long-term process. It's a question of, you know, if the role of property development and construction starts to play a diminishing contribution to Chinese economic growth, What does that mean for commodities? What does that mean for investment in countries that are dependent on commodity exports? And I think that's sort of how that plays out in the future. That's a much slower game. And I think, I mean, it's difficult to answer at this point because we don't really have a sense of how Beijing will respond to a weaker property sector. I mean, we've already seen signs that, yes, the amount of debt that local governments can issue, you know, they've got to ramp up before the end of this year. And, you know, maybe that we're going to see a change in, maybe we're going to still see plenty of work for construction companies. It's just the nature of that's going to change. I mean, Guo Shuqing, the chairman of the banking regulator, gave a very strange speech about a week ago about how his vision of common prosperity involves construction still being a pillar of the economy, but it's going to be involved in sort of more environmental projects and urban renewal projects. I mean, he was talking completely outside of sort of the general realm of his responsibilities, but it kind of raises questions. Do the authorities still have a vision of how to kind of slowly offset the weakening of a property market by kind of coming up with new ways or new sources of sort of public works and state investment? So, I mean, you'd kind of envision that, yes, there will be knock-on effects to commodities, at least globally, but the actual impact, well, it depends on how, you know, it depends on sort of how Beijing's priorities change over the next few years.
Yeah, actually on this, of course, this is something many international bond traders have been very much occupied with. Everyone tries to figure out to what extent the Chinese bond issuers on the international market will actually default and so on. I would say as a Chinese, I know there is, yeah, maybe some of the bonds will be defaulted. But if I were a bond portfolio manager, I would pick and choose the issuers very carefully, because Evergrande is a very different story in the sense that its chairman, even way before this recent event, was already politically very, very vulnerable. There were many reasons for authorities and officials to want to go after him. So he was already a very politically fragile figure. Somebody was just trying to find some angle to really get him, right? And then here now, you know, inability to make interest payments, and then the international media's coverage just made him even more unacceptable. So what I'm trying to say is, if the international media play up Evergrande and other cases, so that will be the best protection the international bondholders can actually get. Just look at last week, SAFE, the State Administration for Foreign Exchange, had to come out to effectively tell the real estate developers who issued dollar-denominated bonds that if you have a problem, tell us what the problem is. And then out of that meeting, they learned that, wow, you know, the exchange channel was blocked for them to have to spend a lot of time converting renminbi into US dollars. That delayed the bond interest payments a lot. Then basically SAFE said, okay, we will, you know, your points are very well taken. We'll look into that. So already the government agencies have taken steps to make sure that the international bondholders, you know, after so much bad international publicity, will be at least to some extent protected. So this is why if international bond portfolio managers pick those bond issuers who are very quiet politically, who are not in the national spotlight, then they're going to be the ones who have to make good on the promises to international bondholders. But in contrast, for many of the domestic lenders, because most of them are state-owned. So if I were, I mean, I used to be on some major banks board. I mean, nobody would say, wow, if this bank would lose a lot of money, I would feel a lot of pain. Well, not really, because it's owned by the state. If this bank loses all the money and more, And I will still eat my lunch and my dinner, have my monthly payroll made to me. So why do I have to be so concerned? So I think in the end, because a lot of such deals are made with a lot of political pressure from local governments, and then in the end, the local governments will have to get the banks to pay for much of the losses. But the international bondholders overall should suffer disproportionately less from future fallouts. Anyway, that's my take. I think I mean, as all of you know, the Chinese have this tradition of trying to save face, especially on the international stage. So China does not want to look bad too much, at least not too much.
The only thing I will add to that is, China is also facing some real geopolitical woes in terms of how much OECD countries want to be integrated with China with supply chains and technology issues. And the voices from the financial community are the ones running in the engagement area in that direction. So basically Wall Street, London, et cetera, like people really still want to be invested in Chinese markets. And so to alienate those communities would be pretty unwise, I would say, if the people who end up really getting hit, not on the chin, but directly in the face, right, would be the global financial community, then China would really lose a series of allies. I'm not totally sure how aware they are of that, but they're not stupid. So I would assume that they are.
Yeah, our panel is still going strong, but it's getting rather late in Hong Kong. So I would say one last question, and it comes from somebody, I'm guessing based in Hong Kong, who asks, does the Hong Kong financial sector have any special role to play in managing either Evergrande in particular or the Chinese real estate mess in general through this crisis?
I guess I'm physically in Hong Kong, so I should go first to take this. I would say for Hong Kong's business community, for the most part, stay out of the real estate mess on the mainland. I mean, the real estate mess on the mainland is too big for Hong Kong to handle anyway. But I think in terms of the dollar-denominated bonds, that's a somewhat different story because most of those bonds have been underwritten through Hong Kong-based brokers. So they have benefited from this while the going was pretty good. So now well, as one of my friends said to me 2 months ago, well, the law firms based in Hong Kong will benefit either way. So when they were issuing bonds, they made money. And then when they're defaults, they still make money. So some businesses in Hong Kong will benefit from whatever chaos this may lead. In fact, the more chaos there will be, and then the more the service sector in Hong Kong will benefit. But I have to say, the University of Hong Kong will probably not benefit from it either way, because we don't get much donations anyway from the private business community. That's a joke, sorry.
Those of us based at academic institutions could feel that joke. Meg, Dinny, did you want to add to that in any way? Okay, then I think it is time to thank our panelists, and I will turn things back over to Mark to conclude the program. But thank you very much. This has been very stimulating.
Great, Ken and Meg and Zhiwu and Dinny, thanks so much for the lively discussion this evening. The conversation has surely shown us the history and social dynamics that have shaped the Chinese real estate market. And most importantly, we've explored an aspect of the Evergrande issue from several academic perspectives, which is really important for us to try to achieve with this program. Now we have a brief poll on tonight's program for the audience on Zoom. If you're watching live on Facebook or YouTube, you can leave your comments in the comment section and we'll incorporate those into the poll results. While you complete the survey, I just wanted to share with you, I think Ken mentioned that we have another program following up on this Evergrande issue coming up on Chinese real estate for an upcoming program on, this January. It'll take a slightly different angle, and we'll hear some progress on how this Evergrande crisis is shaking out. If you've enjoyed this evening's program, we'll feature other expert speakers on that program in January, and you'll most definitely want to hear from them as you did from the guests tonight. Make sure to follow us on our Facebook, Twitter, Instagram, YouTube, and the UN Campus website for further information about our UN Campus upcoming events. We look forward to seeing you again soon. Have a great night.